The headline you keep seeing says Florida's insurance crisis is getting better. Governor DeSantis announced rate reductions in spring 2026. Citizens Property Insurance filed its first rate decrease since 2015. 17 new insurers entered the state. The reforms are working. That is the story the industry wants you to hear. Here is the story the industry is not telling you. The market is softening in South Florida. In Broward County, homeowners are seeing Citizens rate cuts averaging 14.1%. In Miami-Dade and Palm Beach, private carriers are following with reductions between 7 and 11%. For the first time in years, policyholders in the most distressed southern markets are getting a break. But while that story is being celebrated at press conferences in Tallahassee, something very different is happening 400 miles to the north. And the homeowners living through it are not being invited to any press conferences. My name is David Cole. I am the editor-in-chief of Housing Intel. This channel exists because the real estate industry has a financial interest in telling you things are fine. We do not. Subscribe now and join the people who are making decisions based on data, not on spin. Let us get into what the numbers actually show. The first thing you need to understand about Florida's insurance market is that it does not behave like a single state. It behaves like 5 or 6 entirely separate insurance markets layered on top of each other, each priced on its own risk profile, its own hurricane history, and its own proximity to the coast. The statewide average that gets announced at a press conference means almost nothing to a specific homeowner in a specific county. What matters is the rate in your zip code, in your county, in your geographic risk tier. And when you look at the data by region, the picture that emerges is the opposite of what the headlines are reporting. The national average for homeowners insurance in the United States is approximately $1,900 per year, according to Insurify. The statewide Florida average in 2026, after all the reform-driven rate cuts, sits at roughly $3,815 per year, according to data compiled from Florida Office of Insurance Regulation filings. That is still 51% above the 2021 level before the crisis began. Now let us go county by county in the north, because that is where the real story is hiding. The Panhandle's insurance premium data is the first major data point the reform narrative ignores. In northwest Florida, specifically Escambia, Bay, and Okaloosa counties, the current premium range for a standard single-family home runs from $2,915 to $4,740 per year, according to insurance comparison data for 2026. That is not the crisis-level pricing of Miami-Dade, but it is premium pricing that is arriving in markets where median home prices are dramatically lower than in the South, which means the insurance burden as a percentage of total housing cost is often higher in the Panhandle than it is in parts of South Florida. Bay County, which contains Panama City and Panama City Beach, is carrying the direct legacy of Hurricane Michael, a Category 5 storm that made landfall in October 2018. That was not a theoretical risk assessment. That was actual catastrophic damage to actual homes. 7 years later, Bay County homeowners are still living with the underwriting consequences. The Central Panhandle Association of Realtors reported in early 2025 that insurance affordability had become a major factor in slowing transactions. Days on market in Bay County reached 102 days, an increase of 18.6%. Listings were up 14.8%. Closed sales were down 13.5%. The association's own president stated directly that insurance costs were increasing buyer payments significantly and forcing buyers to look for lower-priced properties or negotiate harder on price. In Panama City Beach specifically, Redfin data showed median home prices down 13% year over year as of mid-2025. Pause on that for a moment. Panama City Beach, a coastal market with white sand beaches and Gulf access, saw prices fall 13% in a state where the overall narrative was stabilization and recovery. Insurance was identified as a primary driver by the local realtor association. That is not a market that is getting better because of tort reform. That is a market still absorbing the downstream consequences of a storm that hit 7 years ago. Before we go deeper into the county-level data, drop a comment below. Are you a homeowner in North Florida or the Panhandle dealing with insurance costs right now? Tell us which county you are in and what you are seeing on your renewal. Your data helps us build the next report, and if you know a Florida homeowner who needs to hear this, share this video right now. They are almost certainly not getting this information from their insurance agent. The second piece of the story involves Northeast Florida, specifically the Jacksonville Metro Corridor, Nassau County, and the St. Augustine Coastal Zone. The current annual premium range for a standard home in the Duval, St. Johns, and Flagler County area runs from $2,185 to $4,005 per year. That lower end of the range looks manageable until you understand the conditions attached to it. The $2,000 range applies to a home built after 2002 with a newer roof under 15 years old, with wind mitigation features, located away from the coast. A property that is 10 years older, with a roof approaching 15 years, located in a flood-adjacent zone in St. Augustine or Jacksonville Beach, is not getting that quote. That property is getting the upper end of the range, or it is getting non-renewed. This is the detail that does not make it into the Reform Celebration press releases. The rate averages are improving at the portfolio level because the new policies entering the market are newer, better built, and lower risk. The older housing stock, the homes that actual working families and retirees on fixed incomes own, is still being priced aggressively or is being shed by carriers entirely. 70% of Florida homeowners reported experiencing rising insurance costs or coverage changes in a 2024 Redfin survey. That number did not vanish because citizens filed for an average rate cut. It reflects the lived experience of the majority of Florida homeowners, which skews older and owns properties that predate the most aggressive building code reforms. The third data point connects insurance directly to home values in a way that the industry never discusses publicly, but that the data shows clearly. In Lee County, the Zillow tracked home values in Fort Myers Beach are still approximately $200,000 below pre-Ian levels as of 2025. 86% of sales in the area were coming in under list price. In Sanibel Island, which peaked near $1.3 million before Hurricane Ian, values had fallen to approximately $868,000, with 93% of homes selling under list price. The research arm at Delta Terra Capital, an investment firm focused on climate and insurance risk, described the dynamic directly. When property values fall in hurricane-vulnerable areas, insurers interpret that decline as a warning signal, which leads to increased scrutiny in underwriting and potential premium spikes. It becomes a self-reinforcing cycle. Insurance costs rise, values fall, which triggers more insurance scrutiny, which pushes costs higher again. That cycle played out fully in Southwest Florida after Ian. It played out in Bay County after Michael. And the question that nobody in the reform narrative is asking is, which northern Florida markets are currently early in that same cycle? The fourth piece of data takes us back to Citizens Property Insurance, which is the clearest window into where the real stress in the market actually lives. Citizens peaked at 1.4 million policies at the height of the crisis. As of January 2025, it had declined to approximately 395,000 policies, the lowest level in 14 years. That reduction is being cited as evidence that the private market is healthy and absorbing risk. What it does not tell you is where those policies went and on what terms. The private carriers that are absorbing depopulated citizens' policies are doing so with strict underwriting criteria. Roofs over 15 years old are essentially uninsurable on the private market in coastal zones. A roof between 15 and 25 years faces surcharges and limited carrier options. A roof older than 25 years may only qualify for Citizens, and Citizens is actively trying to reduce its exposure in exactly those categories. The median age of a home in Florida is approaching 30 years. In many North Florida communities, in older neighborhoods in Jacksonville, in the historic zones of St. Augustine, in the established residential areas of Pensacola and Panama City, the housing stock is older than the Reform-era building codes. Those homes are the ones being quietly shed. The owners of those homes are receiving the non-renewal notices. And the data on who owns those homes points directly at the demographic that watches this channel. According to Census Bureau data, the home ownership rate among Florida residents 65 and older exceeds 70%. These are not people with 30-year mortgages on newly constructed homes. These are people who bought their homes in the 1980s and 1990s and have paid them off. Their roofs are old because the houses are old, and their insurance options are narrowing faster than the reform narrative acknowledges. The fifth and final piece of data is the one that tells you where this is going. Insurify projected Florida's statewide average annual premium at $8,458 by the end of 2026, an increase from the current reported average. That projection reflects the continued impact of hurricane exposure, rising rebuild costs, and the underlying fragility of the new entrants who have replaced the carriers that failed. The American Prospect reported in November 2025 that insurers rated by the Demotech Rating Agency, which is the agency that approves most Florida carriers for mortgage lender compliance, were 30 times more likely to become insolvent than those rated by major agencies like AM Best or Weiss. Between 2017 and 2025, 17 Florida insurers declared insolvency within 1 year of receiving a ratings from Demotech. The homeowner who thought they had coverage from a Demotech-rated carrier did not find out that carrier was undercapitalized until a claim was filed and denied. Here is the honest picture the data actually shows. Florida's insurance market is improving for the subset of homeowners who own newer, code-compliant, well-mitigated properties in areas that have not had a major storm in the last decade. That is a real improvement, and it is the result of real legislative reforms. For everyone else, the picture is more complicated. Premium levels remain 51% above 2021 across the state. The Panhandle is paying $4,000 plus per year on average homes because Bay County is still being priced for the Michael risk. Northeast Florida coastal zones are approaching the same premium range. The oldest, most affordable housing stock in the state is being shed from private markets and left with a shrinking Citizens or no coverage at all. And the homeowners who are most exposed to all of these pressures are the ones on fixed incomes who own homes built before 2000, with roofs approaching replacement age in counties that do not have the political weight of Miami-Dade when it comes to reform priority. If you own a home in North Florida and have not reviewed your insurance situation in the last 12 months, the data says you need to do it now. Not because the sky is falling, but because the reform celebration being broadcast from Tallahassee is measuring the market at the portfolio level, not at the level of your specific property. And those two numbers can be very far apart. Housing Intel publishes 3 reports every week, Monday, Wednesday, and Friday. Every one of them is built on verified data, not speculation, not opinion, not real estate industry talking points. Subscribe if you want the full picture, and share this video if someone you care about needs to hear it. We will be back with more.